Hello everyone, and back with a new video. The stock market showed great strength and momentum in the last 2 weeks. Many stocks were breaking out from the downtrend and were either approaching or hitting their 52-week high. The rally was likely fueled by strong jobs report and the debt ceiling resolution. So, what's stopping the boost right now? And if you are still a bear in the current situation, what is your plan? Let's discuss some of these questions in this video. And oh, at the end of the video, I will also show you the period where I bought shares last year, so do watch till the end, okay? The stock market rally showed further strength last week with all three major indices popped close to 2%. Just to highlight, the Nasdaq clinched a 6th consecutive green week, a feat that was not seen since 2020, the start of pandemic. To make things even better, there are signs that the breadth of the rally is improving, which means more stocks and sectors are participating in the latest rally, instead of just the tech and AI stocks. Last week, US reported that their non-farm payrolls rose by 339,000, much more than what was expected at 190,000. In the past, strong employment data had added pressure on the stock market, as it creates a notion that the Federal Reserve has to increase more interest rates. The reason is simple, because more jobs, higher salaries, lower unemployment rate means that people are still doing very well, they can still spend, and inflation will likely remain high. However, last Friday's data showed that the average hourly earnings rose less than what was expected, and the unemployment rate was also higher than anticipated at 3.7% versus the estimate of 3.5%. These two data points gave investors hope that the Federal Reserve could put on hold its interest rate hike campaign this month. Finally, the concerns surrounding the US debt ceiling have eased, which further improved investors' sentiment. With all this good news in place, the market continued its rally. Looking ahead, the next possible market catalyst is on 13 June, where the next CPI report will be out. Then, on 14 and 15 June, the Fed will meet to discuss on whether there will be another rate hike. Therefore, this week, it could be a relatively quiet stretch in terms of macro news and economic reports. Furthermore, the earnings season is winding down as well. In terms of company-specific news, Apple is expected to introduce its mixed reality headset on Monday. The headset will take on rivals such as the Meta Quest from Meta, who recently unveiled their next generation mixed reality headset, the Quest 3, ahead of Apple's VR debut. Meta's Quest 3 is priced at $499, while Apple's new headset is expected to be priced in the thousands. Anyway, Apple's event could shake things up for both stocks this week. Moving over to the technical analysis segment, SPY is looking great as it closed above August 2022's high. Here's what to look out for this week. At the moment, SPY has drifted out of the top Bollinger Band. Usually when this happens, we can expect some form of pullback in the next few trading days. Just to be clear, I am not saying SPY will crash from here. A pullback can be a major or a minor one. In an uptrend, small pullbacks are actually healthy. Therefore, come this week, I would expect SPY to retest 425 and 426 level again. This level used to be a resistance, which has now turned into support. If SPY can bounce off this area after retesting it, it is very bullish. As long as this area holds, there is a possibility for SPY to slowly grind up to 430's range. Heavy resistance will only come in at 442 to 445 area. I think it's quite tough for SPY to hit this area honestly before the FOMC meeting. The upcoming meeting as well as the CPI number will be quite crucial as to whether SPY can hit this 442 to 445 area in months to come or even break above it. But if let's say SPY loses momentum and closes below 425, 426, we can expect the small gap between 422 to 423 to be filled. The important support level comes in at 420, the level that almost every trader or technical analysis fanatics have been talking about. Honestly, at this point, even if this 420 level gets breached, I think bulls shouldn't be too concerned. Reason being, we have multiple support levels below it, such as the 50 moving average at 411 and the gap between 407 to 408. Bulls should only be concerned if SPY goes back below 400 and starts to retest the 61.8 Fibonacci level at around 395. Once again, as mentioned in my previous videos, the hope for bears right now would be a hot CPI number, surprise from FOMC meeting, or some other black swan event. At this point, I wouldn't bank on any of them yet. Remember, trade what is presented in front of you and not predict what's gonna happen. Let's now have a look at Apple's chart. Apple, wow, it's simply amazing. It's on this monster parabolic run. Within a week, it took out March and January 2022's highs, and as a result, created an all-time high right before their event on Monday. Okay, for information, typically when the stock blew past its all-time high, sellers tend to dry up temporarily, while at the same time, FOMO buyers tend to start stepping in. This will then bring the stock even higher, something similar to Nvidia. The next huge resistance for Apple is actually at 187. But before you get all too excited, just sharing my view here, I personally would not chase this rally. It's way too extended. If anything, I would at least want to watch how Apple moves after Monday's event. It could well be a buy the rumor, sell the news scenario, and Apple may take a break on Monday or Tuesday. But again, I could be entirely wrong. Feel free to chase this rally if you wish to. Alright, here's a quick shout out for support. This channel needs your support. You can do so by simply tapping on the like button or comment something below. Even if it's just a simple liner like thank you for the video will be helpful. It will boost the YouTube algorithm and push the video to more audience. Alternatively, you may consider signing up for a Weibo brokerage account using my referral link below. It basically works like Moomoo and Tiger. Finally, if it's within your financial means, you can consider buying me a coffee that will cost you USD $3. Anyway, similar to SPY, Apple has closed outside of the top Bollinger Band. Technical wise, it has to come back into the band. On the downside, the gap between 175 to 176 is shouting to be filled, with 175 as a support. Once 175 broke, can you see the big gap there? That range is between 166 to 170, and bears will target to fill it if 175 gets breached. This area is also where the 50 moving average sits and should offer some form of good support. Beneath this area, there is actually another gap, but I think we should take one step at a time. It is quite unlikely for Apple to fill that gap from now till the release of the next CPI number. Hopping over to Tesla's chart, Tesla seems to be joining the tech rally right now. Well, better late than never, right? The chart is looking pretty impressive with 10 green candles in the last 12-13 trading days. It also did a textbook break above resistance move by printing 2 to 3 green candles above the 200 moving average, which currently sits at 198. On Friday, it tested February's high but could not break above it, and I think we can expect Tesla to test this level again come this week. If bulls can print another 2 green candles above this level at around 217, we will then enter this consolidation zone that was created between May to July 2022. This also means that it is likely we will unlock more upside towards 235 or even 240s range. While 217 to high 230s, that's about 20 points or about 9 to 10% upside. But yeah, here's the but. Always be prepared for the downside as well. A look at the RSI shows that Tesla is very overbought. Therefore, a small break is needed and it will be healthy. I mean, we can chop around the current range, pull back maybe 2 to 3%, no big deal. As long as 200 moving average holds, we should be fine. However, if we have 2 or more red candles below this level, expect Tesla to retest the first Fibonacci level at around 174. Even if it breaks below this, no sweat, because so far 159 area seems to be holding up quite well. Bears should only be excited if 159 gets breached. Okay, let's now move on to Google, where the chart looks really interesting. So while I was away, Google pulled back from 126 to 120 support level, which it held, and then it bounced back up to around 125 area again. At this junction, it appears that 125 is a big resistance that Google has to overcome, as it has been consolidating beneath this level for the last 11 to 12 trading days. Just to share, the longer it consolidates, the bigger the next move. This was what happened when Google consolidated from March to May in a tight range. Okay, back to what I said earlier on, that the chart is looking interesting. I know the tech rally is going on, I know Google is part of the AI play, but I thought to highlight that there is a bearish cross on the MACD. It is interesting because 4 out of the last 5 sustained MACD bearish cross saw Google plummeted. So if it happens this time, watch out for 120. I repeat again, watch out for 120. If we get about 2 or 3 red candles below 120, we have a very high chance to fill the gap at 113 to 114. More weakness will bring Google back to this consolidation zone below, with support at 105. We've all said there was still a time where MACD had a bearish cross and Google did not decline much, and also another time when bearish cross did not sustain and the MACD curved back up again. So if let's say the AI rally continues and MACD curves back up again, then Google needs to break above 125 to be full-blown bullish. That is when we will unlock a lot more upside to the 130s range, with some resistance only coming in at around 135 to 138 area. Okay, let's now cover some of my option trades. As I was away for about 9 to 10 days in the last 2 weeks, I wasn't able to watch the market too closely. When I was back in Singapore last Wednesday, I wanted to sell a put option for Tesla, which is a slight bullish move, but I did not manage to do it. And Tesla rallied hard in the next 2 days and it is overextended now as the RSI hit 90 with 10 green candles in 12 trading days. Therefore, I told myself not to chase the rally and wait for the next pullback. And this is what I would like to share with the viewers. Don't force a trade, be patient, wait for the setup that favors you. And you have not already heard, sometimes doing nothing is the most difficult thing to do for traders. Anyway, as I was not able to sell a put option, I sold a covered call option instead. Okay, in case you get confused as to why earlier on I wanted to sell the put, which is a slight bullish move, but then now I am talking about covered call, which is a slight bearish move. Am I contradicting myself? Well, not really. Again, my stand is short-term wise, the market is bullish. So the reason why I am selling a covered call simply because stock market or a single stock does not go up in one straight line. Tesla is a little overextended right now, hitting resistance level of 200 moving average, and so I foresee there could be minor pullbacks here and there. Therefore, as long as it does not go above my strike price of 285 before expiration date, I will get to keep the premium that I collected right from the start. Well, it's not a lot, it's only $100+, but I will take it anytime. Just to share, I could have gone for a higher premium, but hey, we are in a so-called bull market right now, and I do not want to fight against the uptrend, and therefore I decided to choose a strike price that is far away. At that point when I sold the cover call contract, Tesla has to rally 40% to reach my strike price. Then, Tesla continued to rally after I sold the option and blew past the 200 moving average resistance level with 2 to 3 solid green candles. And as of Friday's closing, Tesla is 34% away from my strike price. Still some room and buffer for it, so let's see how this trade turns out. On a side note, I have a Tesla put option that was sold about 1 month ago on 8th of May. Have shared the rationale in my last video. For ease of reference and recap, basically I saw a few short-term bullish signs back then, namely a mini inverse head and shoulder pattern, a bullish MACD cross, and a bounce off the Fibonacci level of 159. And true enough, Tesla rallied and never looked back since then. This contract should likely expire worthless, unless of course Tesla crashes to 140 by next week, which is a more than 30% decline. Oh, by the way, just to share with everyone, you will realize this period that the premium isn't that attractive if you are selling options, because the VIX is at about 2-year low. In case you don't know, VIX measures the fear and expected volatility in the market. It looks like there is no fear in the market right now, and also not much volatility. That is why the IV has been crushed and premiums are cheaper. Alright, let's share some of my thoughts on the continued rally in the stock market. About 2 months ago, I have shared that the market is very resilient so far this year, as it was very beaten down last year. Many investors have scaled back on their exposure in the stock market previously, and right now, it is quite evident that money are pouring back in. To put things in perspective as to how resilient this market is, here are some of the series of events that had occurred since late last year. So, we had a regional banking crisis where we saw a few banks collapsing at the start of the year. One of them was the second largest bank collapse in US history. Then, we had the Federal Reserve delivering its 10th consecutive interest rate hike. Meanwhile, US was on the verge of defaulting its debt, though some say that it will never happen. Well, that's another story. And then we have the US citizens' credit card debt jump to nearly $1 trillion. In the meantime, inflation remains sticky with the latest PCE data coming in hotter than expected. And finally, geopolitical tensions never stop with the ongoing Ukraine-Russia war, the Chinese spy balloon saga, and the China-Taiwan tensions, etc. And yet, the S&P 500 is up about 12% this year. So why am I listing down all these events? My point here is I am surprised that there are still people shorting this market, and I am quite sure that their trades have been very red in the last few months. Once again, I have repeated many times, don't hold on to a permanent bias, don't insist on being bearish, don't insist that market has to go down and that this is a bear market rally. I mean, well, it could well be a bear market rally at the end of the day, but the current momentum, yes, the existing momentum is uptrend, and fighting against the trend is a mistake. Remember, trade and invest based on price action, on what is presented in front of you instead of what you think it should be. To add on, if you had been following me, last year I shared that it was a short the pop or short the bounce year, mainly because every rally was followed by a decline. But this year, it seems to be the opposite, because every 1 or 2 days of decline was met by another 2 to 3 days of rally. Therefore, it appears to me that the strategy right now is to go long with every pullback. But the caveat is that the current market is overextended and we will never know how deep or huge the subsequent pullbacks could be. So don't start pouring all your cash in. As per my usual strategy, dip your toes in, bit by bit, and you should be fine in the long run. If you still don't get what I am trying to say, a summarized version is that the current market could crumble, we could crash to another new low. I mean, nobody truly knows what's gonna happen from this point, right? But right now, right in front of us, the market is sending bullish signals, so go with the trend. And if you are a long-term investor, have a plan to pick up shares gradually in the subsequent pullbacks. Whether it is a small 2% pullback or a huge 5% drawdown, this is how you increase exposure if you have been sitting on cash, and I am one of them. I am guilty of that. Again, if you have been following me, you will know that I have been picking up shares last year. And for you curious viewers out there, this will be the first time I am sharing some screenshots of the period where I picked up shares at discounted price last year. Sorry that I am not able to share the exact details such as the date and prices of the stocks. So yep, this shows that I did not lie about picking up shares last year. Anyway, seems like I have gotten some good deals, right? As most of the stocks are up quite a fair bit this year. Well, I did, but I have to also be honest that I have not been able to deploy much of my cash this year, as I only managed to buy Tesla and Meta. Anyway, for majority of investors out there, you should not follow my style because mine is a little bit of trying to time the market. Hence, I would say monthly DCA could be the way to go for you. All in all, picking up shares gradually, whether done through my style or the traditional DCA, will help to minimize any sudden market reverses. Never ever pour all your money in at one go. Finally, a quick question, do you think the market is irrationally optimistic right now? Just like how it was irrationally pessimistic last year. I will leave it to you to think about it. Feel free to comment below to let me know your thoughts. With that, do remember to tap the like and subscribe buttons before you exit this video. Thank you.